All right, everyone, welcome to the training today on the simple investment strategies for a brighter future. My name's Jeff Woods. I work here on the One Thing team, and boy, do we have a treat for you today in Mr. Phil Town. You can see his smiling face right there on the screen. He is the best-selling author of the New York Times book, Rule Number One. Get ready. This is going to be a great conversation. Phil and I first got connected through a mutual friend, and we had a great chat over the phone. I absolutely loved the guy, and I knew he could bring a tremendous amount of value to you today. So we're going to dive into that. Before we get into the content with Phil, I want to give you guys a heads up that we have two social media platforms that we've been spending a lot of time focusing on. The first is Facebook, which you can see the URL there. We're doing live streams twice a week, really working to engage with you as much as possible. And we're also jumping on Snapchat so that you can see the behind the scenes of what it's like to be on the One Thing team. So if you are on those platforms, we welcome you to follow us there and interact with us there. And today we are going to cover 5 things before we get into Q&A. And the first thing that you're going to learn is Warren Buffett's 2 rules for investing. And I'm going, all right, I want to know what's inside Warren Buffett's heads, and it's only 2 things. I can do that. We're going to talk about the 4 basic principles that every investor should know. Why you should only invest in up to 20 companies in your entire life. How to buy with a margin of safety, and why the majority of professionals out there don't do what Warren Buffett does. This is something that Phil's going to dive in deep with us. We're going to have a great conversation around this. While we go through this, please submit your questions in the chat box. I've got my team here. They're going to be looking for your questions. They're going to flag them. So that way, when we get to the end of the training, we can make sure that we dive in. So don't wait. Put your questions in while we go through, because we're going to get to Q&A at the end. Now, as always, we like to take a quick glance over the One Thing for those of you who are new, joining us for the first time. Actually, out of curiosity, how many of you have read the One Thing before? If so, put the number 1 in the chat box. And if not, put a question mark in the chat box. That way we can get a sense for who is here today. Let's see these coming through. Right. Okay, a lot of number 1s. Okay, some question marks. All right. Very nice. So it looks like about 75-25 so far. So awesome. So for those of you who are new, welcome. The idea of the One Thing really boils down to a simple principle of productivity, which many of us are familiar with, called the 80-20 principle. The idea that 80% of your results can come from just 20% of your efforts. But we want to encourage you to go even deeper, to the point where you narrow it down to one thing. And the focusing question of the book is, what is the one thing such that by doing it will make everything else easier or unnecessary? And when you do the one thing and you do it consistently, not only does it make a tremendous impact in your life, but it ends up spilling over into other areas of your life. And this is actually backed by research. In 1983, there was a researcher named Loren Whitehead who wrote in the American Journal of Physics that a 2-inch domino could not only knock over another 2-inch domino, but it could actually knock over one that was 50% larger. So a 2-inch domino can knock over a 3-inch domino, 3-inch domino can knock over a 4.5-inch domino. And when our research team was investing the 5 years that went into writing this book, they decided to have a little fun with it and see how far it could go. And this is illustrated here on this graphic, which is on page 14 of the book. And if you took that 2-inch domino at the very beginning, if it went 18 dominoes in, knowing that every time it can knock over something 50% larger, by the 18th domino, it would knock over the Leaning Tower of Pisa. By the 23rd domino, it would knock over the Eiffel Tower, which is a massive structure. It's way bigger than the one in Vegas. By the 31st domino, it would knock over a structure that loomed 3,000 feet taller than Mount Everest, the tallest peak in the entire world. And by the 57th domino, it could almost reach the distance from the Earth to the moon. Here's why I share this with you. When you get clear on what your one thing is in a certain area of your life, and you focus on just knocking it down day after day, for a while, it may not seem like much is happening. Look at this curve right here. For a while, you don't see much growth. But all of a sudden, by the 57th domino, boom, you have this hockey stick growth. And that's what success really looks like. And when we talk about today, investing and your finances, it may not be a huge difference right off the bat. But when you continue to do the right activities time after time, you may just find that this completely transforms your financial world. So how do you make this a habit? We know from the research that we did back in the University of College of London, they did a study. And in 2009, they asked the question, how long does it take to establish a habit? And what they were looking for is that point when a new behavior becomes automatic or ingrained. The point of automaticity is what they call it. And they came to find that participants were 95% through the power curve before it required a lot of energy to do it. And on average, we know that it takes 66 days to form a habit. I know there's a lot of different numbers and a lot of challenges out there about, is it 21 days? Is it 30 days? I've done them all. But for me personally, on average, it took 66 days. The research held, at least in my life. Now, overall, it ranged from 18 to 254 days. It could be less, it could be more. But on average, we know that it takes 66 days to form a habit. So for those of you who, out of all the areas of your life that you recognize, hey, my finances is where I need to make that change, know that you're probably going to need to continue to form that habit over about 66 days. And how do you find the area of your life that you actually need to make that habit in? And this is what we call the 7 circles. Gary and Jay would argue that these are the 7 most important areas of your life. At the top, at 12 o'clock, you have your spiritual life. Because at the end of the day, all of us at one point in our life are going to ask, why are we here? So what's the one thing you can do for your spiritual life, such that by doing it, will give you that sense of purpose here? What's the one thing you can do for your physical health? Because guess what? If you don't have your body, you don't have much of a life. What's the one thing you can do for your personal life, whether it be your hobbies or the things that you enjoy that bring happiness to you? What's the one thing you can do for your relationships or your job or your business? And for today's training with Phil Town, what's the one thing you can do for your finances, such that by doing it would make everything else easier or unnecessary? So that's the 7 circles here. Now, I want to welcome our guest today, Mr. Phil Town. He's a hedge fund manager and a 2-time New York Times bestselling author of both The Rule 1 and Payback Time. He first learned to invest with the Rule 1 strategy back when he was in the Grand Canyon, of all places. He was a river guide, and he was on a tour group, and one of the members shared his formula for building wealth. And Phil's the type of guy who loves to take action, so he took $1,000 of his own money back in 1980 and turned that into over $1.45 million in just 5 years. Since then, he's been featured on TV, radio stations, including CNBC, Fox, MSNBC, and his passion for educating the world on personal investing has given thousands of people confidence to take control of their money and finally to gain financial freedom, which is how Phil and I got connected, and that's why we are bringing Phil to you. So with that, Phil, brother, how you doing, man?
Really good. Can you hear me okay, Jeff?
I can hear you. Hey, everybody, can you hear Phil? If so, put yes in the chat box. Let's see if they hear you, Phil.
All right, good.
All right.
I love what you just went through there. I think this is just brilliant, brilliant, brilliant. Man, the idea of knocking down these dominoes and ultimately the impact of that is this hockey stick curve is straight into, it plays straight into how you make a fortune, how you can go from $1,000 to over $1 million in a pretty short period of time. And it's all about that power of compounding over time. And it really does impact you farther down the road. It's like initially you don't see the changes, but oh my gosh, one day you wake up and all of a sudden you're a millionaire. And it's since I did it, I can tell you it's kind of a surprise. You've sort of been working, got your nose to the grindstone. But this principle is in play, and while it's in play, it's fantastic. You know, the end result just pops out at you, and there you are.
I love it.
Suddenly wealthy.
So Phil, I sent you a request over to share your webcam. Everybody can probably see my face as well. Oh, I'm coming from this angle. All right.
Let's see here. Share the webcam.
You
Do you see me yet?
Hold on. Hey Gary, can we see Phil? No, not yet, Phil.
I shared. Hang on, let me see here. Oh, there it is. Share my webcam.
There he is.
There we go.
With the strong jawline. Ladies and gentlemen, Phil Town. All right, brother. So let's dive into the content today. Talk to me about Buffett's 2 rules for investing.
Yeah, I want to start with something I just was thinking about when you were doing that explanation about the one thing. Um, I was thinking, okay, what would that one thing be for investing, right? If you said just one thing, and it's really simple. The one thing you would do as an investor is make sure that everything you buy, you have a high degree of certainty that in 10 years it'll be worth more than it is today.
Mm.
I mean, we're done now. I'm through. That's it.
Well, Phil,
That's
thanks
the
for getting
whole
dressed up
thing.
for us today. I really appreciate it. It's nice to see you. So how do you do that though?
Yeah, how do you do that? So it starts off with Buffett's 2 rules of investing, which is really the corollary of just focusing on this idea that you want to buy things that are going to be worth more down the road. And the 2 rules of investing are real simple. Rule number one is don't lose money. And rule number two is don't forget rule number one. And so that starting point is critical to understand how we do this kind of investing that Ben Graham started back in the 1930s. He did extremely well. I mean, imagine making 22% a year during the Depression and World War II. And that's what the guy did. And then Buffett, of course, when he started with a very small amount of money, $10,000, he was compounding money at over 100% a year initially, and then 50% a year. And then by the time he'd been doing it for almost 20 years, he was down to, by comparison, a pretty poor showing of only 36% a year.
Yeah.
And so this idea is incredibly powerful. The idea that you should focus your investing not on making money. I mean, that's what we all want to do. But if you focus on that, you're going to get caught up in the emotions of the moment and caught up in trying to do something that's a stretch. And so what we always want to do is we want to focus on every one of our investments is something that we focus on not losing money. And yeah, we're going to have mistakes, but if we focus on not losing money in every investment, then effectively we are buying something that's like a free lottery ticket, Jeff. Essentially, it's like you get a free lottery ticket. You can always turn it back in for the money you paid for it, no matter when. Fine, Mr. Town will give you your money back on your lottery ticket if it didn't win. But it has an upside that can be maybe just a little bit. Maybe you win $10, but you're always in the potential for winning something really, really big. And without the downside, it means that essentially every lottery ticket you buy has only got one direction. You're only going to make money or nothing bad's going to happen.
Can I interject on one thing? Because I remember when somebody shared with me, yeah, focus on not losing money, but when they put it into numbers, it made a lot of sense. And I was just writing this down that, if you started with just $100 and if you lost 50% of that, all of a sudden you're left with $50. But then if you grew that over the next year, that $50 by 50%, that's amazing. You're still only at 75. You're still upside down. And so that is the moment that I was like, okay, now I get why rule number one is what it is.
Yeah, that's exactly right. And that's why it's really boils down to remembering that one thing is to focus on not losing money. If we focus aggressively on the downside and don't do anything until you've got that downside covered, you're going to be a really, really good investor. Now, what it means is effectively you're going to be a really good investor in just a very narrow niche of investing possibilities that you really understand, right? So it could be like we apply these principles to real estate, we apply it to agriculture, we apply it to private companies, franchises, and public companies. There's no difference to us as investors for any of those categories. And that goes all the way back to Ben Graham and Warren Buffett. I mean, some of Buffett's most successful investments have been farm operations, real estate in New York, stuff people don't even know he owns. And the guy has let's say he has maybe 10 really major investments in public stock, maybe another 20 really minor investments, but he owns 60 private companies.
Well, I remember when somebody asked him why he wasn't buying Apple at the time, and he said, probably is going to be a great investment. I just don't know it.
Exactly. It's not in that niche. And so when we look at like, how do we do this? The people get really bogged down by the sheer amount of information, the sheer number of possibilities in the public stock market. So we really like you guys to understand something. If you're, those of you who are watching this, is that you want to think about buying into a business the same way you would think about buying the house next door. Let's say there's a group of townhomes next door, and they're all pretty much the same. Like my mother-in-law lives in a beautiful townhome, like $500,000 townhome, and every one of them is the same. And when the real estate market crumbled in 2009, the place really close by her, just like hers, went on sale in a foreclosure for $250,000.
Mm.
Right? So if she could buy that, now she knows what it would rent for. It would rent for enough money that she would have a good cash flow. She understands the building. She knows the quality, right? She's actually pretty much of an expert because she lives in one.
Mm-hmm.
And she could buy that building right next door for a price that's far below the cost to replace it, far below what it will be when the crisis passes, And that's all investing is. It's that simple.
So talk to me about the 4 basic principles that every investor should know, because I know this is just a perfect segue for it.
Yeah, Charlie Munger and Warren Buffett have been asked so many times, what are the key things that you do that nobody else seems to do that results in these extremely high rates of return, right? I mean, for those of you who don't know, if you had put $10,000, I think it is, with Warren Buffett in the early 1960s, today you'd have $40 million. So it's an extraordinary rate. And if you put that same 10,000 in the stock market, you'd have 350,000. So it's just, exponential giant returns. And everybody wants to know how he does it. And he's been telling people for 50 years. And we'll talk, I hope, about why other investors don't do this. But let me just tell you what he does. And Charlie laid this out for the BBC not very long ago.
This, by the way,
really,
people,
really
is when I said grab your pen and paper because you want to take notes. See,
yeah.
Notes. I'm taking notes.
This might be the time to jot a couple things down. Okay, so the first, we call these the 4 M's. 4 M's. M-M-M-M. So the first one is the meaning of the business that you're buying. The way Charlie puts it is, are you capable of understanding this business? Do you know what it means to be in this business? And he calls that kind of the first level of screen for whether you should be doing this investment. So again, back to our townhome, if you're pretty comfortable that you understand what's going on there, then, or that you're capable with a little bit of research to figure it out, right? You may not know what the rents are, but you can find out, right? So you just have to be capable of understanding. Now, when I first got started, I felt capable of understanding cruise ships, Harley-Davidson motorcycles, and gun manufacturers. Those were my 3 starting
Got some
points.
interesting taste there, man.
I was a gun-loving river guide in the Grand Canyon who rode a Harley. So, easy place to start, right? It's what I already knew something about. So you don't have to be real sophisticated here. You don't have to be doing Apple Computer if that's not something you know a lot about. You'd focus on, which fast food place do you like? I like Burger King, McDonald's, okay? Chipotle Grill, I like that stuff. So just what are you capable of understanding that you really are in a comfort zone so that you're not trying to leap over a 6-foot bar, right? You're not going to make some huge athletic effort here. You're just going to step over a very small bar that you're comfortable with. So that's the first thing.
Can I jump in on that one real quick? Because that hits home for me. When I first started my journey into the world of entrepreneurship, at the time I thought I wanted to be a real estate professional as a profession. And I didn't want to go single family. I thought I wanted to go to commercial because that's where everybody wants to go. So why not just start there? And I remember looking at deals, doing the due diligence, trying to syndicate the deal to raise cash. And very quickly I realized I was not capable of understanding all the facets. And that's when I ended up forming relationships with the right mentors who just showed me how little I knew. And I am so glad that I did not put my money in because it would have crippled us.
Yeah, how important are mentors, right? I mean, get real. I spent, you did a really nice job on my biography, but I want people to understand. I spent with this guy I met in the Grand Canyon who told me these basic fundamental requirements for investing. He told me those as I apprenticed to him for a year. I put in a year with this guy of hard work to understand how to do this. And that's when I wanted to write about it, because I had read every book you can read about investing, and I'd never seen anybody really lay it out clearly. So I wrote about it. And so the basic idea of being capable of understanding the investment is fundamental. And then the next M is what we call the moat of the business. In a real estate deal, the moat of the business are, the three L's of a real estate deal: location, location, location. Ding, ding, ding. Why? Why location? Because the location of the business provides you with a comfort level that 10 years from now, it's going to be worth more than it is today, no matter how badly you screw it up.
Yeah.
The location is excellent, right? We just were down in Turks and Caicos visiting a friend, and one of the largest developers on the island, and he said that his mentor was a guy who said, look, buy real estate because in the long run, all of my mistakes were taken care of by time. Right, essentially. In other words, he was buying great locations, and even if he paid too much, eventually it got around to being worth more than he paid for it. So this concept of knowing that you're going to buy something that's worth more down the road depends pretty strongly on location or moat. I mean, you have to have something that protects this thing that you own from competitors coming in and just wiping out all of your profit margins. Mm-hmm. So, for example, if you've got a piece of real estate, and you know that a competitor could come in there and just build a whole bunch of really crap low-end apartment complexes, and just everybody's going to move out, nobody's going to pay you the rent. That would be important to know.
Yeah.
Right? What's the zoning of this thing you got? Well, the same thing happens to a company like a Chipotle Grill or a Coca-Cola or a Harley Davidson. Something about that business is protecting it, in Coca-Cola's case, for over 100 years. Mm-hmm. They've been able to push off competition. So you have to find companies that have that thing that makes them capable of being durable for a long period of time. And we call that a moat. And there's a handful of them. They're not hard to understand, but it's very critical that you know what that is. Just like in real estate, it's location.
I remember when I first came to work with Gary and Jay, and one of our early state of the company meetings, I'm presenting my vision for the business. I remember Gary saying, great, what's your protective moat? And I went, excuse me, what is that moat that you can build around your business that will make it very hard for competitors to come in and chip away at it? And thinking about that on the very front end as we build this business. I'm still defining what that answer is, but at least it's top of mind.
Excellent. And so if you watch TV shows like Shark Tank, or you watch The Profit, or you watch The Billionaire Investor, I forget, those are three of my favorites. I love watching them. You're going to see that concept come up over and over and over again when really good investors are grilling somebody that's trying to become an entrepreneur. You're going to hear, what do you have going on here that protects my investment from somebody just coming in with a lower price?
Yep.
And you'll hear it like Mr. Wonderful is going like, you've got to be kidding me. I can take the money you're asking me to give you for 10% of your business, hire somebody off the street with formulas for making cookies, and take you out.
That was
right?
That was really good. I know who you're going to be for Halloween next year.
Not bad. So moat is really, really critical that you understand what the moat is of this business, and that it's not being broken by some innovation, by some creative development, right? You gotta know what's going on in your business.
So let me pause and just make sure that I can recap so people can trace with us. The first is that you have to understand the meaning of the business. Are you capable of even understanding all of the facets of the business? And number two, does it have a competitive moat?
Yep, really good. Then the third thing is that you want to have competent management. So if you're an entrepreneur, what you're looking to do is to make sure before you start managing your business, you've paid off your education, right? You've gone out and you've been mentored, you've been taught how to do this, you've been given the tools to do it properly, and you know how to use them. It's not just some book learning thing that you did. You actually got hands-on with this stuff. And if you're starting a franchise with let's say again Chipotle Grill, you go down and work in the place for a couple of months, right? Get a feel for how this business runs. And if you're lucky enough to have a mentor who knows how to do this and has got the business running someplace, you get involved in that, and you see how that actually works hands-on. That management thing is real important in public companies, right? It's when you're running your own thing, you can judge if you're ready to do it. With a public company, you have to take on the management team that's there. And so the thing that I love to emphasize about this is that you don't have to just buy into whoever's managing these businesses. You don't have to be putting your hard-earned money with people who are doing things in the world that you think are wrong, right? I mean, if you're putting your money in a mutual fund, well, guess what? You're invested in a whole bunch of dingbats who are screwing up your world. I have no idea about, I mean, I can't tell you what your values are. Warren Buffett likes burgers and Coca-Cola. I'm a Whole Foods guy. Okay, you vote your values, and part of that vote is to put your money with management, particular CEOs, who are handling their responsibilities in a way that matches your value system.
So if I'm me, I want to get started investing in publicly traded stocks, Starbucks, Whole Foods, whatnot. How are you even figuring that out?
Well, there's a tremendous amount that's been written about many of the CEOs of these companies, right? So, the CEO of Whole Foods is a really famous guy, and there's all kinds of articles in Wired 2.0 and Forbes and all over. You just Google his name, right? And so you go Google John Mackey, and you've got pages and pages of stuff. By the way, that's one of the things that has made it incredibly revolutionary that people like you and I can actually go out and invest in public stocks and successfully compete with people who've been to Wharton and Harvard and are the smartest guys on the planet running these funds. Not only successfully compete, we can beat them over and over and over again at their own game because we're small, and we'll get into that later. But the internet has made it a very, I would say even more than a level playing field. I mean, the amount of information that's now available at the click of a mouse is simply unbelievable to a guy like me, right? I mean, I'm 68. I've been investing since 1980, and I can't even tell you how much time. I mean, honestly, I really don't know. I know it's in months, not minutes.
Yeah.
And now it's minutes, and it's just like it's such a revolution. I can hardly get my head around what I can gather in the matter of a few minutes. Like guys who do my job used to have like dozens and dozens of researchers to go out and gather this data, and it would take weeks and months to get the data. And Value Line, which is the major collection of stock data on public stocks, used to be $50,000 a year, Jeff, for just the subscription.
It's crazy how much information is out there today. It's easier than ever before. So if I'm hearing you correctly, we've got the meaning of the business, we've got the moat, we've got the management. What's number 4?
Number 4 takes us all the way back to the one thing, right? Number 4 is margin of safety. The 3 most important words of investing, which means that you understand the business, you understand how durable it is, and based on those 2 things, you can project the future of this business to some degree of accuracy, some degree of comfort, right? And maybe you're not going to take the most optimistic view of where things might go, but you've got some good level of comfort. You know that this will be worth more in 10 years than it is today. And based on that, you can kind of figure out what you should pay for it. All right? And what you should pay for it.
The 4th thing on our list was how to buy on a margin of safety. And I'm hearing what you're saying in terms of like you understand the business, you have an idea that there's a moat, you've done your research, you understand the management, they're aligned with your values. But how do you really know? How do you determine that margin of safety?
Well, the margin of safety is critical because you don't really know, right? So when we say we're going to figure out the value of the business, it's going to be within a range of reality, right? And even then things can change because of just the natural changes that happen in life. I mean, things happen, right? There's other ways of saying that, but things happen. And so imagine that you were, I have one of our students is in the mink coat business, the used mink coat business. She goes to garage sales all over her region, big flea markets to small garage sales, and she's looking for one thing. She's looking for mink coats that people are sick of and they're getting rid of because they're kind of politically incorrect. And she's making a very nice 5-figure-a-year income that she uses to invest with out of just going and finding mink coats that are on sale. And so she'll find something that she knows the mink coats, right? So she'll see it, Red Fox, nice, all real. worth, $6,000 to $10,000 originally. And she knows she can buy that at this garage sale for $200.
Hmm.
Okay. So here's what else she has to know. She has to know what she can sell it for on eBay. And she knows that coat. She knows she can sell it for $1,000. So look at the level of risk here.
Yeah.
Zero.
Yeah.
She's buying this thing for 200. She's selling it for 1,000. Okay. Now, what if she finds out that the market's changing and people won't pay her $1,000 now? Somebody offers her 250. Okay, so the margin of safety that she had in that purchase was large enough that even if the retail price collapses dramatically, she's still getting out of it without a loss.
I
And that's
remember that mentor, that real estate mentor that I'm surrounding myself with. He had a rule where he would never buy a commercial asset for over 50% of the value, because no matter what happened in the economy, like Armageddon, he was still good. And
yeah,
I just remember being initially at the beginning just saying, all right, but how do I go out and acquire assets at 50% off?
yeah, okay. Well, it takes a lot of digging
Yeah.
in the real world. And what's nice about the stock market is that the digging happens with the clicks of a mouse.
Mm.
But we need to dig into that because there's something that makes it possible in the most rational of markets, which is the stock market. Real estate's very rational too, by the way, but the stock market's incredibly rational according to the theory of efficient markets. And so we have to understand what would it be that would cause a really smart guy running $1 billion fund who went to Harvard to suddenly sell these stocks for half of what they're worth? What, are we smoking something here? What, I mean, here's this guy from Harvard, and suddenly he's going to sell a stock worth $100 for $50 to me. On what planet would that happen, right?
Right.
Well, it's actually planet Earth, and it happens all the time because emotion gets involved in big money in a big way. That people are not 100% rational. What happens is that we have two very different time periods where it's important to make money.
Mm.
For virtually the entire rest of the world that's managing money, that time period is month to quarter. Okay, so 1 to 3 months is really important. If you don't make money in a year, you've got big problems in terms of like losing your job, losing your fund. Now compare that to me. I don't have anybody breathing down my neck because I'm managing my own money. I don't have anybody telling me I got to make money this month or make money this year. All I know is I want to get a really nice high rate of return with a very low risk, and my time frame is very long. So if I see a problem that's happening, let's say cotton prices are going through the roof because the Arab Spring is threatening the cotton crops in Egypt, I can go buy a cotton t-shirt company that just was at $45 a share 3 months ago. And because everybody knows it's going to take a year or two before the cotton prices to rationalize, this company went to $15 a share. I can buy those guys knowing with huge level of confidence that in 2 or 3 years, they're going to be back at $30 to $45 a share. Okay.
Mm-hmm.
That actually did happen. And it took 9 months for the stock to double. So you look for what we call an event that creates fear of a certain sort. It can't be fear that, oh, this is a terminal problem. This is going to wipe out this company. All right. So you got lumber liquidators out there right now who may go bankrupt because of the problems they've got with formaldehyde coming in from China, wrecking their reputation. So you've got to stay away from that stuff. But then you've got companies like Gildan, this t-shirt manufacturer, where on no possible planet are they going to be in trouble 2 years from now, because Georgia will plant all the cotton the world needs, no problem in the next year. So you've got short-term problems, that is problems that last for a year to 2 to 3 years. And then you've got these long-term problems that could terminate the company. We don't get involved in those kind of problems. We get involved in places where there's an event that's driven by something we know is going to turn around inside of a couple of years.
So I want to pause real quick because I have a bunch of questions firing off in my head, and I want to make sure for all of you who are watching and listening to this, please submit your questions in the chat box because I want to make sure that we can dive in with Phil. We're probably going to go through about 10 more minutes of content or so before we transition to Q&A, so make sure you're loading those now. I want to recap what you said right there, Phil, because it hit me pretty hard, and I think it's important for everybody to understand this. When you look at the fund managers who are doing the big trades in the stock market, they think short term, 1 to 3
Yep.
month periods, because
Yep.
they have to show gains on a quarterly basis for their shareholders. Whereas
Yes.
someone like you or like all of us, we don't need our money out in a month to 3 months. We can play that longer game. And the thing that I'm hearing you say over and over again, I mean, your knowledge about these companies is so deep, but I'm just going, wow, no wonder I didn't generate the type of returns you were, because I wasn't putting in the work. I
There you go.
wasn't doing the research that you've been doing, so that you see that thing happen with Arab Spring and you're like, boom, let's buy. And I'm almost asking, like, what's the one thing I could do? 5 minutes a day of just studying these companies, and eventually it shows itself.
The amazing thing, Jeff, is that I didn't have to become an expert on t-shirt companies hoping that some dramatic thing would happen once in my lifetime to the cotton prices. All I had to do was just do, a consistent amount of reading in a few things. Like I like to read Wall Street Journal, Barron's. Those two things right there pretty much cover everything.
You get that,
And
everybody? Wall Street Journal, Barron's. I'm writing it down, pen and paper.
and what that means is when a company like Gildan, which is this Canadian t-shirt company that manufactures t-shirts for Walmart. If you ever bought a college sweatshirt, you were probably buying a Gildan sweatshirt. You ever bought gold toe socks? Those are made by Gildan. So I wasn't looking for it. I didn't know Gildan even existed, okay? It wasn't in my circle of competence. But I read this headline that, cotton prices are going through the roof, and that the CEO of Gildan, which is the biggest t-shirt manufacturer in the world, 30% of the t-shirt market, so they're front page news when the CEO comes out and says, hey, we're going to just suck it for the next year. Well, I see that, man. I go,
Buy.
Number one, am I capable of understanding the t-shirt company? So I start to read these filings that they make every year, called a 10K, and there used to be you'd have to send in and request for one, you'd get it in 2 weeks. Now it's instantly on my screen, totally free. So I read it and I say, can I understand this as well as I understand that townhome next door? Because that's my criteria. I'm not going to understand Intel, okay, or Microsoft maybe, but I'm certainly capable of understanding Burrito Company or a t-shirt company. So I start reading about it, and the more I read, and what I'm looking to do, Jeff, is I'm really looking to find out it's too hard. Because as soon as I find out it's too hard, I'm done for the day. I'm going to go ride a horse.
Yep.
That's it. Okay?
You
So if I can't find out it's too hard,
You literally mean that, by the way.
Yeah, we got a horse farm here. So I go ride a horse. So if I can dump a company in the too hard box, that's great because I'm done.
Yep.
So if I can't, I go, oh, crud, this is actually looking like I might be able to understand it. Then I'll start reading more and more of the 10Ks. Now this, if I'm really getting into it, this is clearly a company I need to understand. I'm going to do a string of things that will develop kind of a pyramid of knowledge. And that's going to take me 15 hours, 20 hours, right? So I don't want to do that on everything in advance of maybe something wonderful will happen. I'm only going to do it when I see this company is already on sale. So I'm going to do the research on the house next door, the townhome next door, when it's for $250,000. I'm not going to bother as long as it's not in a crisis, Okay, so now I do my work and I see, man, yeah, I'm capable of understanding this thing. I see the moat of the business, huge price moat. These guys produce this stuff cheaper than anybody in the world. Okay, got it. All right, management team, super smart, super dedicated, totally into it, treat their employees all over the world like gold, pay them more than they probably have to. My kind of people, okay, love it, great. Now, what's it worth? I don't get to the what's it worth thing until I've gone through that process. Okay, I'm not going to try to figure out what the worth is here till I've really done my work. Okay, now I look at it and I go, man, this is worth $45 a share. It's selling today for $15. I can buy this because the margin of safety requirement that I've got is just exactly like what you guys said. I want 50% off what it's worth. And I'm not going to buy it unless it's 50% off what it's worth. And that gives me a huge margin of safety. So if Gildan is worth anywhere from $30 and up, and I'm thinking it's 45. I'm buying it for 15 today.
Mm-hmm.
I'm good with that. I'm
Yep.
totally good with that. That works for me.
So this is all making perfect sense to me, and I love how you just used that example because that really just drove it home for me. We're going to transition to Q&A in about 5 minutes, people, so make sure you're submitting your questions so we can go there. Phil, looking at the outstanding things I really wanted to talk about, if I could only ask one, the one is, why do the majority of these investment professionals not do what Buffett does?
It's not really the majority, it's virtually all. It's just a gigantic number. Charlie Munger said it's at least 95% of the professional fund managers know that this is the right way to invest. I mean, essentially, what are you saying? You're buying low and you're selling high, right? I mean, they know that's what you have to do. And they know that the only thing that's going to put something on sale, buy low, is an event that creates a lot of fear, right? So why don't they do it? And the reason we've sort of batted around here a little bit is that they have learned two things. Number one, things don't go on sale that often, and they have to do better than their peer group on a quarterly basis. So you can't just sit in cash as a fund manager and wait for a crisis. You can't do it, but I can. I've sat in cash for 2-3 years at a time, doing nothing. I just go ride a horse. So if I can't find something I understand that's on sale, I'm not going to try to play the game. I'm just like that girl trying to buy mink coats, or a really good real estate investor who knows the cap rate that they want to buy with, and they simply don't change their values. They're gonna find that real estate. Okay? So the critical thing to understand why other people don't do this is, number one, they can't wait in cash. And number two, they have found out from one cautionary tale of a professional manager after another that even if you're making huge rates of return, the upside potential does not offset the downside that happens if you buy a small number of companies and they go down over the next year. All of your money is going to go away. All of it's leaving you, even if your track record is phenomenal. And I'll tell you, the cautionary tale here is for Warren Buffett himself. He had to get that. This is so mind-boggling. I still can't even believe it, but it's true. By 1969, Buffett had a track record of 36% per year, compounded, with people in the 5 Buffett partnerships. But he had 2 years in a row where he wasn't making a very good return, just about a zero return, okay? And those people who he had doubled their money every 2 years for 14 years, they said, I want out. You clearly lost your touch. And it infuriated Buffett so much that he shut down all 5 of those partnerships, bought Berkshire Hathaway with his money, and told people, here's what you can do with your money. Go do whatever you want, or if you want a mutual fund, put it in Bill Ruane's fund called the Sequoia Fund that just started, which turned out to be pretty good. Or you can put it in Berkshire Hathaway with my money, but I don't have to listen to you anymore.
Yep.
Because you're morons. You don't understand the basic fundamentals of this style of investing, which is you wait and you wait and you wait patiently, and then you wait some more. And when the opportunity comes along from the normal ups and downs of the real world, that's when you jump in. And fund managers have learned that if they try to do that, they're going to lose their funds and they're going to not make any money, and so they just don't do it. It's not worth the trouble. It's much better for fund managers to just try to do the market, up and down with the market, and they've learned that cautionary tale, and they just don't do it. It's not worth it for them.
So I want to do this because
Isn't that amazing to me? I mean, isn't that not amazing? I mean, amazing.
I remember hearing that when I read Buffett's book and just being like, you got to be kidding me. I can't even believe it. But it makes sense to me.
Yep.
We're transitioning to Q&A, everybody, but I put something up on the side. Garrett, is that showing up there? Yeah, okay. So 2 things that Phil has done for everybody who's here today that I really wanted to let you know about. First is he does these 3-day transformational investment workshops. They're a no pitch. It's straight content, value. You get a free ticket. So that's the link up there, theonething.com/rule1. And then this is something that he has never done for anybody that for some reason he did it for me. Maybe it's because I compliment him on a strong jawline. But he has his toolbox, which, Phil, why don't you tell people what that is?
Sure. Well, a few years ago, Jeff, I got tired of doing Excel spreadsheets, and I just invested a couple $1 million and built a toolbox for myself that handles a lot of the pieces of information that we try to have before we make an investment. So it automates the process of figuring out what the value of the business is.
Hmm.
It automates a lot of the 4Ms that we go through, makes them a lot easier to figure out. It also does some really nice things with people who invest like I do, like Warren Buffett and David Einhorn and Guy Spear, Manesh Prabrai. These are all really good fund managers who have compounded money at over 20% a year for a long time. And what we do is go into the SEC and find out what they're buying and then put that on the toolbox on a 90-day basis so we can get clues about where some of the best investors in the world are putting their money right now. And that set of tools really, really shortcuts a lot of the work you have to do to get up to speed on a company. And we're really excited to be able to make that available to all you guys who are watching this thing.
So Phil's gifting it to you guys free for 30 days. So he hasn't done that before. So you guys can see onething.com/rule1toolbox. So that's up there. We are going to transition to Q&A. We'll leave that up there so you have those links. But Phil, man, great value. I love the conversation today. So thanks so much, brother.
Well, we look forward to seeing you guys out at that 3-day workshop. I teach that myself for 3 days, once a month. That's my contribution to the world. And then we just go on and go play. And that 3 days is packed. We don't sell anything. There's no upsell. There's no actually. All we do is we force you to really work hard. You're going to go from 9 o'clock in the morning on Friday till about midnight on Friday. And then same thing happens on Saturday. And then we let you out of there at 3 o'clock. You're going to be working with our coaches that are there working on it. So I'll teach you something, and you'll get on your computer and do it. It's a hands-on program that's designed to send you out the door ready to go and go off and start investing on your own.
Cool. So first question came from Anthony Phil, who he showed up for you. So you got a fan. He said, in terms of moat, should only top big companies like MCD be considered, or can smaller mid companies, same industry, have strong enough moat to compete with the large size companies? So how do you identify? What do you do there?
Okay, so moat is all about durability. And a lot of small companies have, if you want to think about it simply, do they have a niche within this larger industry that somebody dominates, right? And you find a lot of times smaller companies have carved off a small piece that the big guys just don't want to bother with. And they're very lucrative and very successful. So for example, See's Candy has a little niche in the chocolate business. They don't grow much, but you don't need them to grow much if you buy them at the right price. They're not Godiva, they're not Hershey's, right? And Buffett bought that company for $25 million. And today it provides $65 million a year in free cash flow up to his company. So you don't just look for the niche and see if they can defend it over a long time. And it doesn't have to be a big company. In fact, a small company, Anthony, can have more volatility to it. It'll move around more, bigger swings in the stock price in small companies than in big companies, because they're not followed so closely by professional analysts. And that means if you catch the swing down, just on the normal ups and downs of the market, you can often buy small companies on sale easier than you can the big guys.
That's cool. I like that. Next one came from Paris, who said, with $5,000 to invest initially, where would you recommend starting? My background's in public education, ESL, dual language, residential real estate, and sustainable building.
Cool. I would say that you start right in those niches where you already have some experience. There's over 250 real estate investment trusts that are public companies in the market. So if you're already pretty familiar with real estate, that's an interesting way to get enormous liquidity in real estate by buying companies that are have expertise in, let's say, hospitals, assisted living homes, commercial real estate, residential real estate. All of those are represented by real estate investment trusts. Also, another niche that you just nailed there is the public education companies. There's a big block of them that have gotten into trouble recently by overhyping the education that they're willing to deliver, and the government has cracked down on them, and they're in the tank. And if you can, I mean, they're in their depression right now. And if you can take a look in that area of the market on public education companies, I think you might find a couple in there that might be really, really something you can understand and where you can price them out and see if now's maybe a good time to buy them.
That's great.
So that's where I would go. Now, the other thing I would do with $5,000 is recognize that to go from $5,000 to a couple $1,000,000 in a few years is going to require leverage. And so might want to be looking into the leverage that you can get from options on some of these companies, right? And I'm not talking about long options. I'm talking about actually doing short options in companies that we really understand. And Anna, we talk about that in the 3-day workshop, and we get people into doing some basic, simple, super high probability options trades where, we've been, pretty consistently making 30 to 40% a year, and on very low risk trades, and that can generate a much faster growth of that revenue than just straight stocks.
Hey, Phil, for the people who are not as seasoned, can you explain what an option is?
Sure. The kind of options we do, we are essentially, I won't get all the way into the whole range of options, but we like to be, if you're going into a casino, the option market is a casino. And so if you're going into the casino, you can be the gambler or you can be the house. We like to be the house. And so one way to think about an option where you're the house, and this is an option that Warren Buffett does all the time, nobody even realizes it, is that you can sell people an insurance policy on the stock that they own. They'll buy that policy in order to protect themselves from it going down. And these people are often hedge fund managers who can't afford to have their fund go down. So they'll buy an insurance policy, and we are the insurance company. We're going to sell them that policy. And what we do is we sell them policies where if we have to buy their stock, we're buying it so on sale, we're getting that mink coat massively on sale. And the fun thing is they pay us for that.
Can I try to reword it and hopefully simplify it a little bit? My understanding is that it's the idea that you can say, hey, it's trading at this price. I'm going to put a certain amount of money down. I'm going to buy this option. That money is gone. You get it now, but I get the right to buy it at this set price in the future. And you're hoping that the stock is worth more than that so that you then come in under. But the idea of leverage is that if you want to go buy a stock, you have to put all the money out up front versus saying, hey, I'm going to buy the right to buy X number of shares in the future. You don't have that much cash today, but it's leveraging it for the future. Is that correct?
We do that, but we don't do it very often, actually.
Okay.
What we do instead is we sell you that option.
Aha.
We're going to sell you that. We're going to sell you a version of that, actually. What we do is imagine that somebody wants to be sure that if the stock price goes down, they don't get stuck. They don't get burned. So let's say a stock's at $50, and they don't want to lose money if it goes below $40. So they can go in and buy an insurance policy that says, if this stock goes below $40, the insurance company will buy it from you at 40, even if it's at 0. And they're going to pay for that. All right? They pay money right up front. It's the premium that you get for the insurance policy. Well, what we like to do is we like to sell them that policy if we want to buy that stock at 40. So we learned this from Buffett. It's so genius, and people don't realize that you can do this, and it's really, really simple. Warren Buffett made $22.30, $22 million in 30 seconds selling someone the right to force him to buy the stock at a price he was trying to buy it at.
Oh, that's awesome.
Thank you very much.
So
I will take your $22 million.
I want to do this because we've got about 6 minutes left, and we got a few more questions. So before we go down this rabbit hole too much more, Joel asked, how much would be a reasonable amount to start investing with?
I think right now I was going to say $1,000 because that's what I started with, but it's 35 years later. So I would say $2,000 is the minimum, but I wouldn't even start with $2,000 until I'd spent at least a few weeks on what we call paper trading tools that allow you to execute these trades, because you're going to start trading with that small amount of money. We're not going to invest. Investing is, I know this is going to be worth more in 10 years, okay? That's a slower process. Trading is very active, requires more from you, but you can start with virtually $2,000. Now, we want you to start with paper trading tools so you get the idea of it before you get in there and start losing real money. But it doesn't take much, and you can do all kinds of trades with $2,000. It'll make you good money.
What do you mean by paper trading tools?
Well, these are tools that
Monopoly
are
money?
online on a brokerage site that we use. We get you set up on the broker. You don't have to open an account specifically, but we get on their tool set. They're free, and it allows us to go back in time
Mm,
and to go and back test a lot of the trades that we're going to teach you. And then when you want to say, okay, now I'm going to make my own decision, they actually give you a $200,000 trading account that's real time, real money, not real money, real time, real data,
got it.
and you trade it like it's real money.
I get to
It
practice.
charges you commissions and everything. And then you can see it's like a game that you can't lose, but you get to see the emotion kicking in when this thing is going bad and you have to figure out, oh, what do I do now? And all of that. You want all that out of the way before you start with real money.
Cool. Jennifer just asked, do you have any thoughts on SEP IRA and if you can manage those yourself or if you use an outside company, and explain what a SEP IRA is?
Okay, so a SEP IRA is just a form of what's called a qualified retirement account that allows you to put money into it, typically about $6,000, but sometimes you have a private company, you can go more, 6,000 per year before you pay taxes on that 6,000. So it gets the money out of your hands before the government gets any, and it has certain rules associated with it about when you can take the money out and what the taxes are on that money. But the key thing is that you can manage a SEP IRA on your own.
Yeah.
And that allows you to make a range of investments that absolutely include options trading, long and short stocks if you're with the correct broker. So some brokers won't do it, but a lot of the brokers that we use will allow you to do a self-directed SEP IRA, and you can manage that thing as if it was just money that you've got without any kind of qualified account.
So would you manage it yourself or okay.
Oh yeah.
Oh no. Okay. So that's what she's asking.
Manage it yourself. In fact, any broker can tell you how to set that up, Steph. So essentially what you'd do is you'd call up, like when you come to class, we'll recommend a couple great brokers for you to use that have the right commission structure for the things that we want to do. And they will tell you, you get on the phone with them and they'll tell you exactly how. They want you to transfer the money over into their safekeeping. So they have it in their accounts. They're fully insured, and it's done in a tax-free way. And they do thousands every day, so you can definitely do it.
I had a mentor early on. I asked the guy, he used to work with Robert Kiyosaki, who wrote Rich Dad, Poor Dad. Robert gave Bill all his money when he wanted to invest it. And I said, if you could do just one thing, shocker, I asked this long before the book, what would you do? And he said, for you, your age, I would set up a self-directed IRA. That way it's not the money market managers doing it, but you can self-direct that, whether it's into real estate or whatnot. And I followed him. And
Yeah.
so um,
In that self-directed IRA, you can manage the money using exchange-traded funds or
mhm.
some really good mutual funds that we would recommend, people I really respect. And you can use tools that we'll teach you at the webinar or at the seminar that help you keep from being in the market when it crashes, because it always does, right? Every 8 or 9 years it crashes. So we'll talk about that down the road.
So let's do this. Let's wrap up for the sake of time. So everybody, I'm going to throw the slide back up one more time. Write these links down if you have not already. If you want to learn more about Phil's free workshop, theonething.com/rule1. And if you want to get 30 days free access to his toolbox where you can see who all the big traders, what the trades they're making, so it can kind of shortcut your learning curve, theonething.com/rule1 toolbox. Just to give you guys a heads up, for December, we have Cameron Harold, who just co-authored The Miracle Morning for Entrepreneurs, who will be joining us. So that is on December 16th at 3 p.m. Central. So you'll see that coming up shortly. And like I said, we're putting a huge focus on building a tribe and a relationship with you through Facebook. I'm doing live streams twice a week, and then I'm going to be regularly inside Snapchat, so you can follow us there. And then make sure you go to Phil's website. It's a great website. He's got a great video on there right on the homepage, rule1investing.com. So Phil, brother, thanks so much, man. I really appreciate it.
Jeff, that was really great. I hope you guys enjoyed it. I sure did, and look forward to doing it again with you one of these days.
All right, talk soon, man.
All right, see you.